Okay, today's goal is to get a general idea that there are many kinds of bonds and there are many kinds of interest rates in the market. Before considering bonds and interest rates, let's consider some other goods, such as a computer. What are the properties and the characteristics of a computer that determines or affects the price of a computer? Probably hard disk, memories, central processing units, and maybe accessories, screen, whatever. These are the properties or attributes of a computer that influences the price or the value of that computer. What about bonds? What are the properties and attributes of a bond that determines and affects the price of the bond? There are four main attributes of a bond that are important for the value of the bond. In other words, there are four important factors that affect the interest rate of a borrowing contract. Time to maturity, borrower's credit risk, collateral value, and liquidity. For time to maturity, imagine you lend £1,000 to Tom and Bob. And suppose Tom and Bob are twin brothers, so they have similar risk characteristics. But suppose Tom wants to borrow only for 1 year, while Bob wants to borrow for 3 years. When the time to maturity differs, it totally makes sense to charge different interest rates. You can say, hey Tom, you are going to repay in 1 year. So in that case, I want to charge 10% annual interest rate. Hey Bob, you will repay in 3 years, so I have to wait for 3 years. In that case, I want to charge 12.5% annual interest rate on you. As we saw in our class about yield curve, usually the longer the time to maturity is, the higher the annual interest rate is, but not necessarily. Okay? The point is, if the time to maturity differs, then the interest rate can differ. Of course, borrower's credit risk matters. The less credit, the higher interest rate, so the lender usually searches a lot about potential borrower. If the borrower has good, decent job and decent annual income, he has good credit history, he has some decent amount of cash in his bank account and so on, then such a borrower can get a good borrowing condition, that is low interest rate. If some asset is used as a collateral for the borrowing contract, then of course the prospect for the value of the collateral matters to the interest rate. The more valuable collateral, the lower interest rate. Imagine you purchase a land near the Cathedral Square, which currently costs £150,000. Suppose you don't have enough cash, so you want to borrow £100,000 from the NatWest Bank. And you tell them, if I fail to repay, you can take my land. The land is £150,000. The borrowed amount is £100,000. Such a situation is called over-collateralization, which is a very good deal for the bank. The bank would feel very secure and would be willing to offer very low interest rate for you. Finally, liquidity matters to interest rates. The easier it is to resell the bond, the higher the bond price is, and hence the lower the implied interest rate is. Suppose you lend money with a 10-year contract, or equivalently, suppose you buy a bond which has a 10-year time to maturity. Originally, your investment plan had 10-year horizon, that's why you bought 10-year bond. But sometimes something unexpected happens and you suddenly need cash. In that case, you have to sell the bond to get cash. If the bond is liquid, then the bond can be relatively easily sold, which is convenient for investors. So if the bond or lending contract is liquid, then because of that convenience, it can be priced highly and hence the implied yield or interest rate can be low. Okay? From the point of view of lenders or investors, two loan contracts or bonds with similar 1, 2, 3, and 4 are close substitutes, like chips and crisp. For example, some investors view US Treasury bills, short-term federal agency issued bank certificate of deposits, and commercial papers issued by very famous large companies as close substitutes, because they are all relatively short-term bonds issued by safe institutions. Let's go back to our computer example. If any of the attributes of a computer changes, then the value of the computer changes. If the hard disk breaks or CPU is replaced with a new one, that would affect the price of the computer. Similarly, if any of the attributes of a given bond or loan contract changes, then the implied interest rate, or equivalently the price of the bond or loan, also changes. For example, if the credit risk goes up or down, or if the collateral value falls or rises, then all these things can affect the implied interest rates of the loan contract, or value of the bond or loan contract. For example, 3-year bonds become 2.5 years bond in 6 months, so their price can be different, because the time to maturity is different. Also, the invention of securitization can lower the interest rates of mortgages. Imagine this is 1970s or 80s or even 90s. A bank provides a 20-year mortgage to a household, but suppose the bank suddenly becomes short of cash. It needs cash. What can it do? Nothing. They still have to wait 20 years to collect cash from the household. Mortgage is a very long-term contract. They cannot say, "We are sorry, but we are sort of out of cash. Could you repay much earlier?" The bank cannot ask that. Nowadays, they have this securitization technique, so there is some way for them to resell the mortgage to some other banks or investors to get cash. In other words, mortgages are more liquid than in the past. And because of that convenience, it's possible that the same mortgage can have a lower interest rate than in the past. Finally, let me talk about change in bond price due to change in credit risk. Why is it that it suddenly became harder for some GIPS countries, Greece, Ireland, Italy, Portugal, and Spain, to carry out debt rollover or refinancing? All over the world, governments issue new bonds every month. And every month, some bonds that they issued 10 years ago or 20 years ago mature, so they have to repay these old bonds. How can they do that? They can spend taxpayers' money to repay these old bonds, but they can also issue new bonds to get money from investors to repay old debts. That process is called debt rollover or refinancing. Basically, to repay old debt, they re-borrow money from investors. Debt rollover or refinancing is not just for governments. Many companies do that too. It just means re-borrowing for repayment. Refinancing works perfectly when things are doing well. But now, suppose something a little bad happened and the revenue dropped, whether it is a government or a company. So that means that their default risk is now a little higher. But once the default risk becomes higher, then the rating agencies will downgrade the rating of the institution, whether it is a government or a company, and therefore their bond price will drop. Remember, some institutional investors such as pension funds, insurance companies, and scholarship foundations, they invest only in super safe assets. Their money is for scholarship, pension, and insurance, so they don't take risk. And therefore, once their rating is downgraded, the bond has less demand and hence lower price. If the borrower does not adopt refinancing, then the story ends here. Their default risk increased and therefore the market price of their bond drops, but the borrower wouldn't care. The amount they owe is the same. But if the borrower adopts refinancing, then things are different. They do care about the market price of their own bond, because they have to issue a new bond to repay the old bond. If their bond price is low, then by issuing a new bond, they cannot raise enough money to repay the old bond. Refinancing is much more difficult and therefore default risk is even higher. which completes this vicious circle, and this process might continue on and on and on. This mechanism is sometimes called debt multiplier effect of refinancing. But the point here is just the rise in default risk causes the bond price to drop, or equivalently the interest rate to rise, and that effect is even stronger when the borrower adopts reborrowing. What I have explained so far is that if any of the attributes of a bond changes, then the bond price can also change. But even if nothing changes about a computer, the price of the computer can still change if the demand and supply condition in the market changes. So, even if attributes of a given bond remain unchanged, its price is still subject to change if the demand and supply in the bond market changes. But that's not today's topic.